A very good evening to you, all of you students. So today we will continue, or let's say rather, we will start with another topic on dividend decisions. Good evening, Kiran. Good evening, Rajiv Kumar, Bhumika, Darshan. Yeah. So students, this topic is very, very important, and it's. I mean, for the overall understanding of how the dividends are decided by the companies, or let's say what goes as a thought process for the companies to decide whether to pay dividend or to do what with that amount, and hence to increase the wealth of the shareholders. So this topic is very relevant to have a overall understanding. Lok Sundar, good evening. Sudhanshu Shekhar, good evening. Yeah. So in the entire financial management, there are a lot of decisions that we take, and some of them we have already studied. So for example, the first one that comes to our mind is financing decisions. Correct. So now what would essentially be included in a financing decisions is that if let's say you need to finance certain investment, so what is the right source of that finance, whether it is equity, whether it is debt, whether it is a mix of equity or debt, or whether there are other things which in today's world that exist that you can take as a financing decision. Krishna, good evening. Sonali, Manisha, good evening. So this is what about financing decision is. Second is investing decisions. Now, investing decision would typically mean that if your business is generating some returns, so where would you invest those returns? Where would you invest the idle cash? Or if you want to expand, whether do you really want to invest into that expansion or not? So some of this is linked to the capital budgeting decisions that we have already studied, correct? This I'm saying investing decisions would help us to analyze or to help in a better understanding whether we want to do investment and particularly in what type of instrument, correct? And third, let's say bucket of decision under the financial management would also include dividend decisions. So Bhumika is asking some question on scenario analysis. I will come back, Bhumika, on that because we have a separate session also planned on the revisionary part for both dividend as well as this one. So I will take that query then. Sayed, good evening. So on the dividend decisions, now the companies are faced with a dilemma that, if let's say, okay, let's first try to see the balance sheet of a company. I'm just making it in a T format. This is a old format. Okay. So let's say here are equity and liabilities, and here are assets. So if you see in a balance sheet of a company, what all things you will find mostly. Komal, good evening. First, you will find, oh, you won't find Komal, good evening. You will find, first of all, let's say property, plant and equipment, which is fixed assets. Correct? Earlier, we used to call it as fixed assets. Now it is property, plant and equipment under NDS. Then you will also find, let's say, some of the working capital related assets, inventory, debtors, then cash and cash equivalents, correct? And so on. The list will keep on continuing on the asset side. On the liability side, what all things you will get? First of all, share capital, reserves and surplus. You will also have creditors, and let's say some other current liabilities. Correct? So now ultimately, let's say for 1 year, the profits that the company has earned is sitting in the reserves and surplus, and the corresponding cash is idle here. It is kept in the, let's say, normal bank account in a liquid form. Okay, so the cash is sitting in cash and cash equivalent, and the profit is sitting in the reserves and surplus. Now, what is the issue with company? Now, the issue with company is that whatever profits the company has earned, it has two options. One, to retain it. Or if, what do you mean by retain? Let's say retention means that you are again utilizing that amount in business itself through investment. So let's say you want to expand your business. You want to do a greenfield investment. You have to put up a new plant. For that, you will, whatever you have earned during the year or the previous years, you will use that and retain it in the business. Or the second option is because the investors, the equity shareholders have invested the amount in a company for some cash flows, which is given in the form of dividend. So the second option available with the company is to pay dividend. Okay. So I hope the problem statement is clear. I'm trying to define the problem here. Then we will go to how, and then we will try to understand how to solve this problem for a company, right? So if you see, I mean, some of you might be thinking that this problem is not that big. But let me tell you, in this kind of a situation, how would you analyze this? Let us just try to elaborate this problem. Okay. Now, let's say the company is earning 100 crore profits per annum on a constant basis for last 5 years. Okay. So very likely we can expect that in next year also it could be 100 crore per annum. But suddenly in one of the year, there is an abnormal gain of 500 crore only for 1 year, because this is an exceptional gain. Let's say the company had some land and it was carried at cost. Now suddenly the company sold that land at a very high price, which is the fair value. And hence this 500 crore gain came in the financials of that company. So Darshan is asking if a company provides dividend, if it has profits only. Okay, now Darshan, for this is a regulatory aspect. For regulatory aspect, we need to check what is written in the Companies Act. Because Companies Act has certain conditions laid down. Whenever you want to declare, those conditions has to be fulfilled. And this profit is one of them. Not only current year profit, but the cumulative profit. Okay. So this is the regulatory aspect that you will be studying in your law related topic. Okay. In this, we will cover the decision making part. So 100 crore per annum for last 5 years, but in this year, only for 1 year, it is ended up having 500 crore. That means 600 crore profits for that particular year. For the last 5 years, the company was habitual in paying 80% as dividend. And hence the shareholders are also expecting 80% dividends year on year of whatever the company is earning, and balance 20% as retained earnings. Now think yourself as board of directors of the company and try to answer this, that whether this 600 crore that you bought, whether this also you will split in 80-20, or you will just keep this 500 crore as reserve and balance 100 crore, which is any which was expected by the shareholder, that only you will split as 80-20. So there are multiple permutations and combinations, right? For board of directors to analyze this decision, they would need help from us. Correct. Because we will guide them that what is the right thing to do. Because if the market expectation is that on the entire 600 crore, 80% should have been given. Please mind my words, market expectation. I would link this word in the future part of my session. Okay. The market expectation is that the company will, again give 80% of 600 crore and you end up giving only on 100 crore, then your price will go down in the market. And hence your wealth maximization will not be achieved. Okay. So try to think. I'm just trying to give you all the problems that are faced by the company. So this is one. Okay. So first of all, the problem is how much to distribute and how much to keep. Second is, let's say if there is some kind of abnormality in the profits or in the losses, both, because this situation is holding true. If there is a very big amount of abnormal loss also, then what you're going to do. Okay. So these are some of the problems. Now let us also try to understand one more thing, that while we talk about dividend, can you all put in your query handle that what are the I mean, how can a dividend be settled? How can dividend be settled? Or let's say, what are the different sources? Different sources for settlement of dividend. All of you, please put. Okay, Bhumika, I will explain. Meanwhile, I request all of you, please put what are the different modes and please think aloud. Okay. So again, I'm saying in my session, there is nothing called as right. There is nothing called as wrong. Please, all of you attempt whatever comes to your mind, please put. Okay. So that at least we will try to activate our brain cells in terms of thinking. Now, Bhumika is asking, please, again, the abnormal part again. Okay. So Bhumika and rest all, please listen that in case there is, so let's say here the case I've taken is company is getting 100 crores per annum for last 5 years. Okay. And this is a very normal profit at a very steady rate the company is earning. And company was also under the policy that whatever it earned, out of that 80% it was distributing dividend and rest 20% as retaining its earnings. Now what happened essentially in one of the year, sudden increase in profits has happened because of any reason. I took it as an example of sale of land. Let's say the company had sold some land which it was carrying at cost, and now because the fair value is very high, the company sold it at fair value and the entire gain came as 500 crore. Now, what will you do with this 500 crore extra? Would you also allocate in the ratio of 80-20, or will you keep this 500 crore in your reserves and balance 100 crore you will distribute as 80-20? That was the problem. Okay. So Swati is again saying, okay, so Swati is trying to answer, I think, the regulatory part of the question. Dividend rate and all other aspects are prescribed in law under Rule 3 of Section 123. Okay. Darshan is answering, I think, cash in bank and bonus shares. Very good, Darshan. So the dividend can be settled through cash bank or through bonus shares, which is fine. So Manisha is saying profit of the year or general reserve. I think, Manisha, I'm trying to ask that, okay, so not sources of dividend, I'm saying sources for settlement of dividend. How dividend would be settled. But you are right, Manisha. The sources of dividend will be profits for the year or general reserve, which is fine. Bhumika is saying cash payment, perfect. Aisha is saying issue of shares, cash credited to bank account of shareholders, perfect. Varsha is saying dividend by cash in view of bonus share or redeemable preference share. Okay, very nice. Komal, reserves. Okay. Sudhanshu, bonus or cash and bank. Okay, so I think Komal is again referring to the sources of dividend, but sources of dividend, reserves and profits are fine. So all of you have attempted, I think, very well. So I think most of you have answered these two things only, which is there in all your mind. One is through cash outflow. By cash outflow, we mean through bank credit, right? Then there is, let's say, warrants, check, ECS, whatever you can say, ECS, checks, and there are sometimes called as dividend warrants, correct? Which will carry, which is as good as a check. Yeah. And the second option is actually bonus shares. Can I tell you third option? Please think it aloud. What has Paytm done? So there is one company which is also trying to give it in the form of shares buyback. See, what is dividend? Please don't restrict dividend to whatever is the return on shares. No, whatever extra amount you're giving. So in case of shares buyback, let's say the market value is something X, but you are purchasing at premium. That means you are giving a return to the distributor, right? So even shares buyback are part of is one of the mode to settle the dividend. Now in bonus share, what happens? You will give, let's say, 1:10. So one share for every 10 share held. ultimately what will happen, whatever is the total investment, that will remain same. So bonus shares never increases the wealth of shareholder, but what it will do is it will divide the entire investment by 11 and he will be able to sell one share with which the return would come to, and the return can be actually liquidated. Okay, so bonus shares increases the liquidity in the hands of shareholders. So these are some of the modes to settle the dividend. Dipanshu is saying dividend payout ratio. Yes, we will cover that concept, dividend payout ratio. Dikshita is saying reserves. Yes. Sudhanshu is saying ECS. Yes, ECS is the electronic form of payment of dividends. Dikshita, reserves is again the sources of dividend. Okay. I hope these points are clear. Let's move forward. Now, till now, we have not come in the solution. Dividend is paid in cash or in kind. Yes, it can be paid in kind also. So sometimes what happens, let's say in the form of dividend, what they will do instead of paying cash, they will distribute the inventory or they will distribute the plant and machinery. But this has happened very less. Okay, so practically this has happened very less, although there is guidance in the accounting standard also how to account for these transactions, distribution of non-cash to the shareholders. Okay, but I am restricting everything to the resources outflow, which is as good as cash outflow. Okay. So let us try to understand that what is the significance of dividend policy. Now, once we know that how crucial this decision is for a company, the companies are devising dividend policy, right? Which will be the governing framework for how much dividend needs to be paid. That means what is the dividend decision going to be? A would be long-term financing decision. So what do we mean under this significance is that we need to always think it from the long-term financing decision perspective. Now, please listen this discussion very carefully because this is going to be the base of the entire future. I mean, entire session, entire balance of the session. Let's say there is an investment opportunity available with a company and that investment is fetching a return of 20%. Okay, please listen very carefully, students. That investment is fetching a return of 20%. And the market expectation, I'm linking this word again back to what we discussed earlier. The market expectation is that on the shares, or let's say on the investment that has been done in this company, the market expects a minimum return of 18%. Return on equity. This we called as KE. Always denote this as cost of equity, which is return on equity. This is always from market standpoint. So market is expecting at least 18% of return, but I have an opportunity in which the company, if it invests, it will be able to generate a return of 20%. Now assume that the surplus with company in the form of cash profits is around, let's say, 100 crore. So what do you think company should do? Okay, Swati is saying, but as per law, dividend cannot be paid in kind. Okay. So that is where the regulatory thing comes up. But if you see it from the operational standpoint, so this point might come that, in that case, how will you decide whether to pay or not? Correct. And hence I have restricted my discussion even on the cash outflow part. Okay, I think Dikshita and Bhumika are saying, explain on the shares buyback again. Now, again, I'm not pretty sure about law. Okay, because again, in law, shares buyback might not be a dividend because for law, dividend is a narrow term. But for us, we're including dividend as anything which is distributed to the shareholders. Now, what happens? Let's say the buyback value is, let's say, 1,000 rupees, but the current market price is only 800 rupees. So what will happen? You have paid 200 rupees extra to the shareholders. So essentially mean you have distributed 200 rupees extra. And buyback would also happen in a way that they will say, we will buy back 1 out of 10 share. You're getting my point? So what will happen essentially, 200 rupees equivalent of 1 share for every 10 shares held will go as a dividend to them. Okay. So I'm just trying to open the perspective here. Again, I might not be the right person to say whether law allows it or not, the shares buyback. As Swati is pointing out that dividend cannot be paid in kind, correct. But what we are trying to discuss here is something more than what is defined by law in dividend, is what I'm trying to say. Okay. So even shares buyback is also one kind of dividend because you are paying something extra or you're distributing the shareholders' wealth to them. Okay. Now coming back to this, we discussed that there is an opportunity to invest at 20%. The shareholders demand 18%. Let's say this is the company. It has an opportunity to invest at 20%, but shareholders are demanding 18% as return. So don't you think that if the shareholders would invest their money more in this, they will be able to generate 2% extra return beyond their expectations? And this entire 100 crores would be preferred to be kept in the company itself. Correct? Preferred to be invested in the company or retained in the company. I hope this is clear. Because if you keep it in the company will be able to generate a return of 20% and the shareholders still expect only 18%. So 2% extra return company would be able to generate, which again is forming part of the shareholders only, right? Because extra 2% would also will go to the shareholders, but their expectation is only 18%. Okay. So this is the significance. So the significance we always need to think it from the long-term financing decision. And the long-term financing decision is actually driven by that whatever you have to invest, what is the return you will be able to generate and what is the return on equity that you will get. Then B part. Wealth maximization decision. In case of wealth maximization decision, the only point here is that whatever decisions you take immediate, so the immediate dividend, if you give, it will always lead to higher MPS, market price per share, right? Because you're actually distributing that. So this is called as bird in hand theory. Whatever you have now, market will value more than whatever you are giving them a hope that you will pay in the next year or next to next year. Okay. Now let us also try to understand one very good relationship. So let's try to understand a relationship between retained earnings and growth. This is very crucial. This again will be needed in your subsequent sessions. So what happens? Retained earnings and growth. So what is growth? First of all, let us try to define what is growth. This is year 1. And you have earned a profit of, let's say, 100 crore. Again, I'm taking example of 100 crore. Year 2, you end up earning 150 crore. Year 3, you end up earning 220 crore. So can you see growth in profits, right? Till now you were at 100 crore year 1, year 2 you grew by 50 crore, year 3 you grew by 70 crore almost. because from 150 to 220, you grew by 70 crore, right? So this is called as growth. Growth is something which is over and above the last year's performance. And suddenly, let's say year 4, you again came back at 100 crore. So here, this is a degrowth of 120 crore. This is called as negative growth. I hope all of you understand growth now, right? It can be positive, it can be negative. It can be both ways. It is always not positive. So it can be even negative. So negative growth is called as degrowth. Positive growth is any which is called as growth. But what we understand what is growth is equal to incremental to current amount. I hope you are able to make it out. Whatever is incremental to the current amount, that is called as growth. Now, let's say these are the total earnings of the company. From this, I am saying this is the earnings for 1 year. In totality, this box denotes earnings for 1 year. Out of this, they are retaining this portion and they are declaring this as dividend. So this line I have made to say that, okay, this much is retained and this much is paid as dividend. So whatever they have retained, this amount, this entire amount, whatever they have retained, correct? This much they have retained. So this amount will also fuel growth for the next year. Darshan is asking, instead of that 220, if it is 170, isn't it growth, sir? Where you are saying 220 here. Instead of 220, if you say, let's say it is 170, then also there is a growth of 20 crore, right? Because base was 150 crore. So 150 to 170, there is a 20 crore growth. Kiran is asking, what is incremental? Incremental is something over and above. Incremental is something over and above, which is not there in base, but which is higher than the current amount. So this is what I was trying to explain. The earnings, you have to break it in two parts. One, whatever you have paid as dividend, and one, whatever you have retained. So can you tell me what is the incremental income that you will get in the next year? Yes, I can very much tell you. Incremental income would be retained earnings multiplied by return on investment on that earnings. Correct? Whatever you have invested through retained earnings, on that, whatever you are trying to get, that is called as incremental income, which is also called as growth. So this incremental income is called as growth, which is B into R. So B is the retained earnings, which is the retention ratio. And something is called as dividend payout ratio. 1 minus B. So if B is you are retaining, that means 1 minus B you are paying. Correct. We will explain this further. We will discuss this further. Okay, but as of now, please register this thing in your mind that growth is equal to whatever you retain and on that whatever you earn. Okay. I hope this is clear. Kishore has said FSSD. I am not able to understand Kishore. Can you please put it correctly or maybe elaborate your query. Now let us come to, now we are coming to the solution part of the problem. Okay. So till now we have, discussed multiple things. One is what is the problem faced by the company? What are the significance of, what are the two things which are significant in taking that decision? Third is how the dividends are settled, what modes it can be settled. Then what is growth? Correct. So that's what, and what is growth and how it is calculated. Correct. Then let's come to theories of dividend. Thank you, Momita. So theories of dividend, actually this part of the session, we will discuss how theories are developed, what those theories, signify, and some of the practical problems related to them. So whenever we say theories, these are actually developed by some of the renowned professionals. So first one is irrelevance theory. And second one is relevance theory. When we talk about irrelevance theory, this is actually also called as approach, which is actually Modi, Giuliani, and Miller. In this, we will study about Walter's model, and we will also study about Gordon's model. Let's take up this theory first, and then we will go to the relevance theory. Okay, so Sudhanshu is asking what is retention ratio? Retention ratio is earnings minus dividend divided by earnings. Dividend payout ratio is dividend divided by earnings. I would have explained this later, but since this query came, hence I am explaining it now. So D is equal to dividend and E is equal to earnings. So our retention means how much from the earnings we are retaining, which is earnings minus dividend, that much we are retaining divided by the overall earnings. And dividend payout ratio, which is exactly 1 minus B, which can also be seen in like this, dividend divided by earnings. Okay. Now let's first start with approach. Please, students, all of you, please listen very carefully. So first of all, this is an irrelevance theory. Okay. Why it is irrelevance? Because it says that whatever dividend you pay, whether you pay 0 dividend, whether you pay 100% dividend, ultimately it is not going to change the value of your company. The market capitalization, or let's say the value of the company, is not going to change. And they have proved it also. Whatever dividend is paid / not paid, whatever chance you take, whether it is paid or not paid, it will not affect the value of the firm. Okay. And we will prove it how. So it says that, let's say, this is how the stock is moving. Okay. Slowly, gradually, it is coming up. Let's say this was 0. and here it became, let's say 40. This is the 40th amount, 40th price. And ultimately on this date, you decide 5 you will pay as dividend. Then what will happen? The share price will become 35 and 5 will be your dividend. But ultimately the wealth of shareholder will be 40 only, right? Because shareholder will now have 5 rupees of cash and 35 rupees of share. Before dividend, shareholder was having 40 rupees of share and hence it was also 40. This was 0. Cash was 0. So I hope you are able to understand. So they are saying whether you pay dividend or you don't pay dividend, the overall wealth of the shareholder and hence the value of the company remains very much same. Okay, students. So ultimately what is happening is 5 is shifting from one pocket to other pocket. Earlier it was in the form of the shares that I have. Now that 5 rupees is in the form of cash that I have. So Darshan is asking, how did the share price fall after the payment of dividend? Okay, I will explain that. Varsha is saying if pay rupees 40, then what will be the value of share with the shareholder? 0. If you pay 40 rupees as dividend, ultimately you will end up having a 0 rupees of share price and 40 as your dividend. Still your wealth will be 40. Now coming to Darshan's question. So students, there are two terms that all of you need to understand. One is cum dividend price and second is ex dividend price. Now please understand, as we said that the share price is moving up and here I declare a dividend. The share price again will come like this levels, right? Let's say here it was 15, it reached to 40. Then let's say 7 rupees I declared as dividend. It will be 33 rupees here. And then eventually it will come up because of the next profits, right? So this 2 rupees is because of the next profit. So 40 is called as cum dividend. 33 is called as ex dividend. So the theory is, or let's say the understanding is that whatever you pay as dividend, that amount will reduce from your share price. Because ultimately share price is reflective of your earnings that you are doing. Hence this 40 is already reflective of the earnings that you have done till now. Out of that earnings only you are declaring dividend, correct? So how much dividend you will declare, the same impact will come to your profits also. Cum means including dividend and ex means excluding dividend. Yes, Swati, you are right. So cum is including dividend, ex is excluding dividend. Okay. And you take any company from the practical life who has declared dividend and try to see that how the share price has moved. So this date is called as record date. Practically, we call this as record date. On record date, what was the pre-price and post-price after the dividend was declared? Because record date is the date on which whosoever is having the holding of those shares, they will get the dividend. Okay, so that is called as record date. So let's come back. I hope this is clear. So let's try to understand these things with the help of an example. Okay. Now, please, all of you, please focus here. I hope the discussion is going fine till now. Example. So in my example, I'm taking, let's say, 2 lakhs worth of equity shares. And the price as of now of these shares is 10 rupees per share. And there is a caveat that company is not having any borrowings. Whatever is earned by company is invested in capex, which is the capital expenditure. Whatever is earned by the company is invested in capex, so there is no idle cash left. The cost of capital, let's say KE, is 10%, because cost of capital is 10%, which is nothing but your expectation from the shareholder. So let us try to understand that what is the price going to be after 1 year. Okay, let's go step by step. So it is, see, approach is a very step-by-step approach. Whatever steps I'm following, you also follow the same steps. And ultimately, we will go to the conclusion that whatever we do, whether we pay dividend or not, it is not going to impact anybody's life, whether it is shareholder or whether it is company. That is what approach is. Okay. Market price. So the first step is to calculate the market price after 1 year. So this P1 is equal to market price after 1 year. P0 is actually the price existing as of now, plus into 1 plus K, which is the growth. I mean, not growth, but the expectation, or let's say the amount by which the expect that P0 would be at P1 minus D1. Correct? Whatever dividend I'm paying, that should be reduced. So this is the formula. Here P1 is equal to price at the end of the year. P0 is equal to price at the beginning of the year. Cost of equity is cost of capital. Correct? And D is equal to dividend, D1 rather, paid during the year. Or you can say at the end of first year. This is actually a bit subjective, so it depends question by question. Sorry. Okay. So hence I have used both the words that are used in the question. Dividend paid during the year and at the end of first year. So up to first year, whatever dividend is paid, that is D1. So in this case, we have assumed that, let's say, case A, the company is not paying dividend. Okay. In such a case, P1 will be 10, 1 plus 10% minus 0. Hence, P1 will become 11. So the value of company, which we also call as firm. So this is not called as, I mean, don't go by the legal entity name here. Firm means company here, okay? 11 into 2 lakh. 2 lakh are the number of shares. That means 22 lakh is the value of the firm. Case B. So we have to prove that if the company is paying dividend, then also the value comes as 22 lakh rupees. So Yashika is asking, what is 1 plus KE? 1 plus KE, Yashika, is actually the making the future value to present value. Or sorry, the present value as future value. Because if you see, this is the present value and you will multiply with the discount rate, 1 plus discount rate, or let's say this is the return rate, KE rate, to arrive at the future value. Okay, this is another way to understand this. So the case B, we are saying that the company pays dividend, but by issuing new shares. Because we have assumed that whatever company is earning, that is already invested in capex, right? So for paying dividend, the company needs funds, correct? Hence the company pays dividends by issuing new shares. Now in that case, let's say the dividend is also paid at the rate of 3 per share. That is also given. Okay. So the amount, so first of all, we have to calculate the price at the end of 1 year. 10, 1 plus 10% minus 3. I hope this is okay. So P1 is what? 11 minus 3, which is 8. New number of shares required to be issued will become, so on 2 lakh shares, we have to give 3 rupees per 3 rupees per share as dividend, correct? So 2 lakh into 3 is the total fund requirement, and you will issue new shares. The new shares are issued at 8 rupees per share as per the revised price. Yes, Bhumika, you are right. P1 is 8. So that means you will end up issuing 75,000 shares more to fund your dividend. Okay. So to fund your dividend, the company will issue another 75,000 shares at the rate of 8. Okay, perfect. Thank you, Swati. Okay, so case B is 75,000 shares. Now the value of company slash firm, whatever it is, will be 8 is the new price multiplied by 2 lakh were existing shares plus 75,000 new shares. So 8 into 2 lakh 75,000, which is equal to 22 lakh rupees. So this is same and this is also same. Whether you pay dividend, in case A, you are not paying dividend. Case B, you are paying dividend. The value becomes same. So it says that you have your free will. Whatever amount you have to pay as dividend, you can pay. Mathematically, financially, it has no impact on the wealth of shareholder as well as on the company's valuation. So we can derive 2 more formulas from this. If we are saying, let's say P1 is equal to P0, 1 plus KE minus D1. So can we say that P0 1 plus KE is equal to P1 plus D1. P0 is equal to P1 plus D1 divided by 1 plus KE. So if we want to arrive at the price beginning at today, then we will have to just take the price at the end plus dividend declared, anything paid till the end divided by the 1 plus K, which is the present value factor, correct? Because here we are coming from future value to present value. Okay, Darshan? Yeah, thank you. So this is another good formula which is used, which will be used in the questions. And now I'm just putting the overall formula, value of firm. So basically, number of shares multiplied by price, which is also called as value of firm, is equal to number plus delta number. Delta number is the new shares. P1 minus I plus E divided by 1 plus KE. So I'll tell you what is this. So I is equal to investment required. E is equal to earnings that we have done during the year. Delta N is equal to new equity shares issued. Then KE, we all know what is KE. N is equal, and N is actually existing number of shares. Value of firm is equal to value of firm slash company K is equal to cost of equity. So what we are trying to do here is, no, Manisha. This approach is very much applicable if the dividend is also paid in cash. Because in the previous case, if you see case B, we have assumed that dividend will be paid in cash by 3 years by raising new equity, by raising funds from new equity shares. Okay. So it is very much paid in cash, and that is applicable. Now, see students, what I'm trying to say here is that here, this is the present value. Okay. This is the present value because we are dividing the entire amount by 1 plus KE here, this one. Okay, that's why it is becoming a present value. And since in the numerator it is P1, which is the value at the end, and whatever investments we are trying to do minus E plus whatever earnings we have, that will become our total value divided by 1 plus KE. Okay. So you will, again, once we will do one more example on investment and earnings, all of you would be able to better understand this. Okay. Now, straight away, let's go to question number 1. Again, this was, I think, earlier uploaded. So, all of you, please refer that. Okay, so the question number 1 says AB Engineering Limited. So, students, first of all, see this approach to understand, it's definitely some time consuming process, but once you understand, the application is very quick because it has 3 steps. Step number 1, calculate the price at the end. Step number 2, calculate the number of shares to be issued. Step number 3, calculate the value of the firm. That's all. There are only 3 steps. Okay, we will actually try to do it from here. AB Engineering Limited belongs to a risk class for which the capitalization rate is 10%. So students, now see, question is giving actually in different ways the same thing, but it is KE only. Capitalization rate is KE only, right? It currently has outstanding 10,000 shares selling at 100 each. Okay, it currently has outstanding 10,000 shares selling at 100 each. The firm is contemplating the declaration of a dividend of 5 per share at the end of the current financial year. It expects to have a net income of rupees 1 lakh. So earnings will happen at 1 lakh and a proposal for making a new investment at 2 lakh. So whatever you will invest and whatever you will earn, that means you will still have a net amount of 1 lakh to be funded. Plus you will pay a 5 rupees of dividend. So this is your total financing need. Okay, I will come to it later, but I'm just trying to throw some thoughts here. That's why minus I plus E was there. Calculate the value of the firm when dividends are not paid and dividends are paid. That is what we are supposed to do. So first, in case dividends are not paid, so then what will happen? P1 is equal to P0, 1 plus KE minus D1. Correct? First, we have to calculate the price. So P1 is equal to 100, 1 plus 10% minus 0. Because dividends are not paid, 100 is the price at now and 10% is the capitalization rate. So P1 will become 110. Step 2. Calculation of funds requirement. What is the total investment that they have planned? 2 lakh rupees. Minus how much they can fund from the earnings? 1 lakh rupees. Plus, is there any dividend that they are planning to pay? No, because in the first part, we are assuming that they are not paying any dividend. Correct? So plus dividend would be nil, and hence the net amount required is actually 1 lakh rupees. So we have calculated the funds requirement. Step 3. Calculation of number of new equity shares. Number of shares will be issued for 1 lakh rupees divided by 110. Correct? So I'm not solving this. I will be using it as is because unnecessary. Because if you see the formula, once we open the bracket, this 110 from the denominator will get cancelled. Okay, so these are the number of shares which are the new ones, which is also called as delta N. Correct? Step 4, which is the last step. Value of the firm. How much it will be? Value of firm will be N plus delta N P1 minus I plus E divided by 1 plus K. Value of the firm will be 10,000 plus 10,000 are the existing number of shares divided by, plus 1 lakh divided by 110, which is this. Correct? into 110 minus 2 lakh is the investment required plus 1 lakh is the earnings. This whole divided by 1 plus 10%. Hence, the value of firm becomes, if you solve everything, it becomes 10 lakh rupees. This is as on today, because as I told you that this is coming as the value as on today. So step 4, value of the firm is this much. Then we'll go to the second case. When dividend is paid. Okay, I'm just waiting for a moment for all of you to absorb it and note it. Now let's go to the second case. When dividend is paid. Okay, so Darshan is saying, can we directly calculate the value of the firm as 10,000 shares into 10 into 100 as it remains constant? So ultimately, that is only what is happening, Darshan, right? Because what we are doing, first of all, we are standing here. Okay, let's say we are standing here. Then we are projecting what is the price going to be 1 year from now. Then after projecting it, we are again calculating it back here. So ultimately, that is what is happening. So this is 0 and this is 1, right? From 0, first you are going to the future, estimating what should be the price there, what is the fund requirement there. And when you have done, then you are again come back to the present to arrive at the value. Okay. So, but this is the approach that we have to follow because that is what is guided. Then when dividend is paid, how much dividend they are paying? 5 rupees per share. Okay. Now let's analyze this. Step 1. Calculate the price. So the price is 100, 1 plus 10% minus 5. So P1 becomes 105. Second step, funds requirement. Investment. They will do how much? 2 lakhs minus earnings. How much? 1 lakh. Plus dividend. This time dividend, because this is the case we are discussing dividend here. So 5 into 10,000. Existing shares are 10,000, right? So it will be 50,000. This will be added. So 2 lakh minus 1 lakh plus 50,000. So 150 is what you need as an amount. Then step 3. Number of shares. You need 1,50,000 of rupees and you will issue a new equity share at 105. So 1,50,000 divided by 105. Again, I am not solving this because in the formula it will get cancelled. Okay. So better not to go into the decimals and again try to, break down our head to the last rupee. Step 4. In this case only, otherwise, if it is not getting cancelled, then you cannot leave your answer till here. You will have to solve it, okay? But only in this case, I am not solving it further. So the value will be 10,000 existing shares plus 150 divided by 105 as a new shares multiplied by 105 minus 2 lakhs plus 1 lakhs whole divided by 1 plus 10%. Now you are coming to the present value. If you solve this, the value will again become 10 lakh. You can solve this and see the number. And just to summarize, here you have no dividend and here you have yes dividend. No dividend, MPS is 110. Yes dividend, MPS market price per share would be 105. Correct? However, the value of firm is 10 lakhs and here also it is 10 lakhs. So there is no difference. So only the price per share changes, but overall value it remains same as we have seen. Okay. Okay, students, let's move forward. Now let's come to the second part of theories of dividend, which is the relevance theory. So students, for irrelevance theory, the question will revolve around these facts only. They will give you investments, they will give you earnings, they will give you the current price, or sometimes they will give you the future price. They will say that one case we are paying dividend and another case we are not paying dividend. So analyze the impact of these decisions on the value of the firm. So with this, you will be able to know that this is a question on irrelevance theory. Now coming to relevance theory. Under relevance theory, the first part, or let's say the first thing that we're going to study is Walter's model. Okay. So let us first try to understand some basic things. Price into cost of equity. If you do, you arrive at dividend. Correct? See, because cost of equity is what? Cost of equity is the expectation from shareholders. Expectation from shareholders is actually fulfilled by dividend. Can I also say that price would be equal to dividend by cost of equity? In some of the situations, not in all of the situations. So the ultimately that Walter has actually arrived at a formula is actually, see, if you only take this, there is a mistake that you are doing. You are ignoring the retained earnings and hence growth. Correct? If you just simply take this, you are doing that. Okay. So what Walter has actually modified this formula to D plus E minus D R divided by KE whole divided by KE. This is what the Walter's formula is. So P is equal to price of the share, R is equal to rate of return. Okay, this is actually ROI, internal rate of return. Also, you can call IRR, ROI, which is the rate of return. Okay, then KE is equal to cost of capital, which is the market expectation or the shareholder's expectation. E is equal to earnings. What are your overall earnings? And D is equal to dividends. So Manisha is asking, sir, why are we taking cash from the market? Don't the firm have cash? So this is one of the assumption of Modi, Gilani and Miller that there is no cash with the firm. Whatever is the fresh requirement of, let's say, investment or whatever it earns also out of the earnings, that is also even adjusted for calculating the fresh borrowings or fresh equity. Correct. So that is one of the assumption that the firm don't have idle cash, which is hard to believe in today's world. Correct. But still, with that assumption is what the theory is developed. Price of the share is P, R is equal to actually rate of return, K cost of capital, E earnings, and D dividends. Okay, so this is the formula from Walter. Now let's also try to understand one very good relationship between dividend and market price per share. Okay. So this is what the relevance theory is, right? Because relevance theory says, is there any lag? Swati is asking, is there any lag? I'm not getting any other student to report it. So relationship between dividend and MPS, this is what the relevance theory is, right? If you pay dividend, if you don't pay dividend, it has an impact on MPS. But what are the situations? We have to understand that. So first of all, R is equal to rate of return. This topic we have actually briefly touched upon in the significance of dividend policy under the long-term financing, okay? So R is equal to rate of return, KE is equal to cost of capital, which is the expectation from shareholder. So these are some of the scenarios. Relationship between dividend and MPS. Dividend payout. Okay. Now we will understand. So let's say the first scenario is growth case. Okay. What do we say in growth case? Once R is greater than KE, your internal rate of return, or let's say the rate of return that you are driving, is more than what is expected from the market. So that is called as growth case, right? Because you are giving more returns than what is expected. So relationship between dividend and MPS will be negative. So in this case, shareholders would want their money to be invested in the company. They would not want any dividend out of it, because their money is invested in a place which is earning better than their expectation. Correct. So dividend payout should be 0 in this case. Second case, which is constant case, where R is equal to KE, sorry. Once your R and KE are equal, cost of equity, which is the which cost of equity is the expectation, and R, which is the return, are equal, then there is no correlation. Whatever you want to pay, you pay. MPS will not have an impact because of the dividend payment. And dividend payout will be in any ratio. Let's say you want to pay 60%, you pay 60%, you want to pay 50%, you pay 50%. That is fine. Then declining case, where R is less than KE. So declining case is the one where your return generated is lesser than the cost of equity, which is the expectation. In this case, shareholder would want to withdraw money as much as possible because the avenues in which the company has invested the money is making a lesser return than their expectations. Correct. So in this case, higher dividend is expected to be paid, and once you pay higher dividend, it will have a so higher the dividend, higher the MPS. Market price per share will be higher. Please note it down. So Darshan is asking, can you please explain how this formula is derived? Okay, he's asking, Darshan is asking mostly for this. So Darshan and rest everyone else, please also try to look here. See, I've tried to explain that price is derived through this box. Please focus. So the price is derived by dividing the return by some percentage. Correct? That is why you will achieve at this. So this you see would look familiar to you. And this part is actually taking care of the future growth happening from the retained earnings, because E minus D is what? Your retention. Earnings minus dividend is your retention. Into R is what you will earn. Divided by K is again to capitalize that amount. Okay, Darshan? And everyone else? I hope this is also clear. This relationship. So let us break for 10 minutes. It's 7:17 now. We will again reconvene at 7:27. Thank you. So welcome back, students. Let's go to question number 2. So question number 2 says XYZ Limited earns rupees 10 per share. This is their earnings, correct? Capitalization rate and return on investment are 10% and 12%. Capitalization rate is KE. Please try to identify the numbers correctly. The return on investment, which is R, is 12%. Determine the optimum dividend payout ratio and the price of the share, and the payout. So first of all, R is greater than KE, right? Because 12% is greater than 10%. That means company is earning more return than what a shareholder expects. Then what shareholder will do? Shareholder will ask the company to keep the amount with itself and don't pay anything in the form of dividend. Since R is greater than KE, the optimum dividend payout ratio would be 0. Correct? If the optimum dividend payout ratio is 0, then price as per the Walters model, because they are also asking us to calculate the price. The price as per Walters model will be dividend plus earnings minus dividend. Earnings is how much? 10 rupees minus 0 into 12% divided by 10% whole divided by. So what we have done, we have applied this formula here. P is equal to D plus E minus D into 12% divided by 10% divided by 10%. Sorry, I was writing the formula here. My bad. R divided by KE whole divided by KE. This is the formula. So the price basis this 20. Sorry. Okay, students, let's come to question number 3. Very good, Bhumika. Bhumika has given the answer 120. Question number 3. The following figures are collected from the annual report of XYZ Limited. They have a net profit of 30 lakhs, outstanding 12% shares at 100 lakhs. Number of equity shares, they have 3 lakhs. R is 20%, cost of equity is 16%. Compute the approximate dividend payout ratio so as to keep the share price at rupees 42 by Walters model. Now see, in this they have given us some part of the equation, which is the price, and we have to calculate the dividend payout ratio. So again, we will use the Walters model, D plus E minus D into R divided by cost of equity whole divided by cost of equity. 42, because price is given to us, right? 42 is equal to D. We don't know what is the dividend, but we surely know what is the earnings. So for earnings, calculation of earnings per share. So the net profit is how much? Net profit is 30 lakhs. Correct, students? Less preference dividend. So here the catch is whatever preference dividend they have shared, that has to be reduced to arrive at the amount which is available for equity shareholders. On 100 lakhs, multiplied by 12%. That means 12 lakhs. This is 18 lakhs. This is earnings for equity shareholders divided by number of shares. How many number of shares? 3 lakhs. So ultimately, earnings per share is actually 6 per share. EPS, what we call as is 6 per share. No, Darshan. Darshan is asking, there is no P0 and P1 in Walters model? No, because they are not taking present value, future value. They are just simply taking the current price. Okay. EPS comes as 6 per share. Now, this E we have calculated as 6 minus D we don't know. R we know that's 20%. K we know it's 16%. Whole divided by 16%. So now this entire equation, we have to find the value of D. If you solve this, then it comes as D is equal to 3.12 per share. So the dividend payout ratio (3.12) divided by 6, which is actually 52%. Okay. Okay, everyone. So this question was a bit, unique because it has asked us to calculate the BP ratio basis the numbers that were given. Okay. Now coming to, let's say, the relevance theory again, the second theory. So we were actually doing our relevance theory. In that, let's cover the second theory, which was the Gordon's model. Okay. First was Walters model. This is Gordon's model. So first, let's try to see the formula. Here they say that P0 is equal to E1 1 minus B divided by KE minus BR. I will try to explain this. So what they are saying is, what is P0? So let's try to actually redo this equation to understand it better. Okay. So what I'm doing is KE minus BR, I'm bringing up here. E1, 1 minus B, I'm putting here divided by P0. Okay. Can we also write this as KE is equal to E1, 1 minus B divided by P0 plus BR. Now, what was KE? This was expectation of shareholder. See, what will shareholder expect? So what will shareholder expect? Shareholder will first of all say that, see, what is this? E1, 1 minus B is actually the dividend, correct? So shareholder will say that whatever you are earning, out of that you are giving me dividend, that is one of my expectation. And I will divide it by P0 to arrive at the percentage. And in that, I will also add the future growth potential. Because some amount you have not paid to me, some amount you have kept with you. And on that, you will be earning our rate of interest on the amount that you have kept with you. So that is also will be what my percentage that I will add. And hence, This plus this becomes the KE. I hope this argument is clear. So that is why if you again reassemble this proved formula of expectation of shareholders, so you will reach it there, which is what the Gordon has said. Okay. So I'm again re-explaining the expectation of a shareholder, which is the KE, will be whatever that shareholder is getting in the form of dividend divided by P0. That will convert into a percentage. And whatever the shareholder has not been given, but that has been reinvested in the business at the rate of R. So that also he will expect some percentage, which is R into B. If we add them, that will give us the cost of equity. So Darshan was asking in the previous question, R is greater than KE. Shouldn't the dividend payout be 0? Yes, I agree with you, Darshan. But the question has also said that despite of the fact that it is 0, but they have given us a share price and they're asking us to calculate to achieve at this share price, what should be my dividend payout ratio? Okay. So because we are given this specific share price and hence we have used, we are calculating the dividend payout ratio separately. Okay. So I have Gordon's model is clear. Now again, I'm rewriting here. P0 is equal to earnings 1 minus B divided by KE minus B into R. Why I'm writing B into R? Because I've already explained growth is retention into rate of return on that retention. So B into R. Okay. Yes, Darshan. BR is the growth. Yes. In the retention, sir. Yes. Darshan, you are right. So BR is the growth. That's what I just now told. Okay. So P0 is equal to price of the share. Correct? B is equal to retention ratio percentage. How much we have retained. 1 minus B. Dividend payout ratio. Cost of capital. Rate of return. Growth rate. I hope this is clear. This elaboration of the formula is clear. Okay, students, let's come to question number 4. The following figures are corrected from the annual report of XYZ. Again, the same thing, 30 lakhs, 100 lakh preference share, number of equity, this and this. Now they are asking us to calculate the price per share using the Gordon's model when dividend payout ratio is given in the 3 different cases. Now they're asking us to use the Gordon model in the same facts, but they're asking us to calculate in the 3 different scenarios. So first one, when dividend payout is 25%, so the P0, which is the price, will be what? So we have already computed that earnings here was how much? 6 per share, correct? So I'm not repeating that calculation again. That was simply 30 minus 12, 18 divided by 3, which was 6. So this 3 lakh shares and 12 lakhs was the preference dividend. Okay. So what is the formula? E1 minus B So E is 6, 1 minus B. What is the B here? So when DP is this, then B will be 75%, correct? When DP is 25, then B will be 75. So 1 minus 75% divided by 16% minus 75% into 20%, which is 150. Okay. KE minus B into R. When DP is, which is dividend payout ratio, is 50%, then retention ratio will also be 50%. P0 is equal to 6, 1 minus 50% divided by 16% minus 50% into 20%, which is 50. Third case, when dividend payout is 100%, then retention is 0%. P0 will be 6, 1 minus 0 divided by 16% minus 0 into 20%. This will give us 737.50. Very easy, very simple, just simple formula application and we are done. Now students, if you see here, R is actually greater than KE. That means it is a growth firm. Growth firm means DP should be 0. There should not be any dividend payout ratio to have a maximum share price. But what is happening in this case? They have given us 3 different scenarios. They are saying if it is 25%, you see the share price is maximum here. Here it is only 50 and here it is again 37.5. So the share price is maximum at 25%. And even if you take 0%, then it will be even higher than 150. Okay. So hence this formulas, usability is proved that if there is a higher rate of return compared to cost of equity, the share price ultimately will also be higher. Okay, students. Please absorb this and understand this. If you have any queries till now, I am open, please. Or let's say if it is clear to you, please drop at least a confirmation that it is clear so that, we can concentrate on the next part of the session. There is no rocket science in this. It is very easy and, understandable. Thank you, Bhumika. Bhumika is saying clear. So, bird in hand theory. Okay, Darshan is asking, sir, here dividend payout and price are negatively related as R is greater than K. Yes, Darshan, you are right. Why they are negatively related? Because R is greater than K as per the table that we discussed. Okay. Perfect. So now let's focus here. Bird in hand theory. Bird in hand theory is something which says that whatever you have now, this we already discussed somewhere in the previous discussion. So whatever you have now, that is better to an investor compared to the hope that you give him that, okay, I will pay dividend 1 year later. So investors prefer today's certainty over future uncertainty. Correct. Because today, if I have certainty, that is more important than future uncertainty. So what is the formula here? P0 is equal to D0, 1 plus growth divided by KE minus G, which is actually D1 divided by KE minus G. You can write or understand this formula in whichever way you want. I will try to explain this in a normal fashion. So the question, okay, Rajiv Kumar Singh is saying, everything till now is clear. Okay, thank you. But Rajiv Kumar Singh is saying that in relevance theory, the dividend payout will affect the value of firm. Yes, that is what the essence of relevance theory is. Because relevance theory says that if you pay dividend or if you don't pay dividend, it will ultimately impact your value of the firm. Okay. Now we were here. So burden and theory is they prefer today's dividend, which is D0, and it can be multiplied with a growth to arrive at D1 and KE minus G, which is same as the previous one. P0 is equal to price as on today. D0 is equal to dividend for current year, or sometimes question also says last period. Okay, so I'm writing again both the languages what question says. G is equal to growth rate, K is equal to cost of equity. Okay, students. So we will use this formula in some of the questions that are going to come. Okay, but this is another way to write the formula. Okay. So dividend discount model. In case of dividend discount model, the issue, or let's say the outline, or let's say the different thing here is that since dividends don't grow at a regular pace. See, in this case, we have assumed that dividend will always grow at a growth rate of G, but growth rate of G is also going to change, right? Okay, Darshan is asking bird in hand. Bird in hand means whatever you have now, you will prefer that over what you are getting as a hope you will get in future. Okay. Let's say many of the companies gives bonus, right? If you are employed, you will get bonuses, but bonus is what? I mean, it's not part of your regular salary. So your regular salary is bird in hand, but you don't know whether you are going to get bonus or not while you're working for a company. Correct. So as an employee, you would always prefer you get whatever cash flow is committed as on today rather than waiting for the uncertain future. Okay. That is called as bird in hand. Bird in hand means whatever I have with me, that is more preferred. So in this formula, what I was saying, we have made an inherent assumption that growth rate is going to be constant, but that is not the case because growth can never be constant, right? Growth will always keep on changing. So dividend will also keep on changing, right? D1 will be different, D2 will be different, D3 will be different. So they say what you do, you take the different discounting. So D1 is the dividend paid in first year. D2 is the dividend expected in, sorry, not paid, expected in first year. D2 is dividend expected in second year. D3 is dividend expected in third year. So you do the present value accordingly of that. Dn 1 plus ke raised to the power n. Okay, so this is what the price is, right? Because, I mean, if the same dividend, I mean, the dividend is not constantly growing, it will grow at different pace. You will take a present value basis those different pace. So ultimately, students, I'm summarizing all the discussion on the growth. Okay. So there are three cases again. I'm saying one is zero growth. There is no growth. There is constant growth. And there is variable growth. Correct. Because growth cannot be same. In this case, we are assuming constant growth. So there is zero growth. Then the formula for price becomes dividend by KE. Simple. The formula becomes dividend by KE. In case of constant growth, the formula is changed in this manner, which is Bergman theory of Gordon. In case of variable growth, we just now saw it is dividend distribution this one. Sorry. Okay, students. I hope this is clear. So zero growth, there is no growth. It's just simply whatever dividend you pay divided by the percentage, you will arrive at the price. Bergman theory and dividend distribution model because growth is variable. So let's come to question number 5 now. Question number 5. Very easy, very simple. X Limited is a no growth company and pays a dividend of 5 per share. If the cost of capital is 10%, compute the current market price of the share. Price will be dividend divided by cost of equity, which is 5 divided by 10%, which comes as 50. So the price is actually 50. Simple, only one-liner question. Let's come to question number 6. I hope this is clear. Okay, I'll pause for a moment here so that at least all of you are following the pace. Question number 6. XYZ is a company having a share capital of 10 lakhs of rupees 10 each. It distributed current dividend of 20% per annum. Annual growth rate in the dividend is expected as 2%. The expected rate of return on its equity is KE is 15%. Growth in dividend is 2%. Current dividend, which is D0, is actually 10 into 20%. Correct? 10 is the price of the share and 20%, that is 2. The expected rate of return on equity is 15 that you have written. Calculate the price using the Gordon's growth model. So what is the Gordon's growth model saying? D0, 1 plus growth, whole divided by KE minus DR, which is equal to 2, 1 plus 2% divided by 15% minus 2%. Okay, thank you, Bhumika. So P0 is equal to 2, 1 plus 2% divided by 15 minus 2%, which is the same iteration of this formula. So the P, or let's say the price, will be 15.69 per share. Okay, students. Let's come to question number 7. A firm had paid dividend of rupees 2 per share last year. Now you see here they have used the term last year, but as I told you that D0 is as good as current year last year, correct? As of today. So we will use that. The estimated growth of the dividends from the company is estimated to be 5% per annum. So let's write the information. D0 is 2. Growth 5%. Determine the estimated market price of the equity share if the estimated growth rate of dividends rises to 8%, 3%. Okay, so they have given us 3 instances. One is the regular instance, and the other two are the different scenarios. Also find out the present market price of the share given that the required rate of return on equity investors is 15%. And they're asking us to calculate the P0. So the current market price per share, we will just write down the formula D0, 1 plus growth divided by K minus growth. So P0 is equal to 2 into 1 plus 5% divided by 15% minus 5%. So P0 is equal to 21 rupees. Simple. So 2 rupees is the dividend that has been paid as 0, D0, 1 plus growth divided by K minus G. Second case, when growth is 8%. So this is first case, when growth is actually 8%. So P0 will be 2, 1 plus 8% whole divided by 15% minus 8%, which is equal to 30.86. Third case, when growth is equal to 3%, 2, 1 plus 3% divided by 15% minus 3%, which is equal to 17.17. So that's all right. I mean, whatever we needed to put in this formula, that was given very well as a part of the question. And we have concluded the same. Okay, students. Okay, Darshan, thank you. So let's move ahead. So now let's move to some of the traditional theories. Graham and Dodd model, GND model. So they say that price is equal to multiplier of dividend plus E divided by 3. So now what they are saying is actually you will have to see price So I will explain you. So there is no logic to this. What they are saying is earnings have 1/3 weight, dividends have 1 weight. You add them up and multiply with some multiplier and you will arrive at the price. Price per share, M is equal to multiplier, D is equal to dividend, E is equal to earnings. Simple. Okay. Let's come to question number 8. So this is nothing but you will have to just remember this. I mean, there is no logic at least that I can, make it out. But what I'm trying to sense from this is that what they would have thought is that earnings should have a lesser weightage while determining a price, but dividend should have a higher weightage. Again, the burden and theory. And hence they are saying that 1/3 earnings should have weight, 1 times dividend should have weight, and there should be a multiplier basis which determined. So Darshan, this is mostly given in the question. So let's come to this question number 8. The earnings per share of a company is rupees 30 and the dividend payout ratio is 60%. Multiplier is 2. Determine the price as per the Graham and Dot model. So earnings is how much? 30. DP ratio is 60%. Dividend hence will be 60% multiplied by 30, which is almost equal to 18 rupees. Multiplier is also given as 2. So P0 will be 2, 18 plus 30 by 3. Correct? So P0 will be this much. Because dividend is this much and 30 is actually the price. 30 is actually the earnings. So 30 divided by 3, right? 56 is the price. So Bhumika is asking which theory is the most appropriate one for a good dividend decision. So Bhumika, all these theories have their pros and cons. Okay. Now some of the theories have some inherent assumptions. For example, M&M approach said that you don't have any idle cash. You are working in a perfect capital market. There is no insider information that is going outside. So there are a lot of things, or let's say there are a lot of assumptions basis which all of these are meant. Now, even, if you see the Gordon's model, it assumes that growth rate is going to be constant, which is never the case. Correct. So, I mean, these are all we are studying just to, widen our horizon, or let's say widen our thought process that, okay, basis these lines, at least we can come to some kind of a conclusion that what is right and what is wrong. Correct. Ultimately, it is up to the management. So we can propose to the board, right, that this is good because this is actually, as per this theory, this is fitting it out. But there is no straight answer to say it as what is right and what is wrong. Aisha is saying, why do we have a multiplier here? That's what. So Aisha, as I said that in this formula, what Graham and Dodd has, said. So this multiplier is something which you expect, which at least okay, so let me, tell you like this. If you talk about valuation, okay, so the first thing, and I'm talking about, let's say, startup valuation. The first thing that comes to your mind is in startups, there is only top line, but there is no bottom line. So the profits are not there, right? Those are losses mostly. And even EBITDA is also negative. So how will you do a valuation? What they do is they say that, okay, take your sales and multiply, let's say, 7 times. Roughly, let's say sales is 1 crore. 7 times you multiply So the value of your startup is 7 crore. That's how sometimes evaluation happens. And even the broader perspective of valuation also is derived from this. Some people take a EBITDA multiplier. I think you would have heard. So on EBITDA, they will multiply. Let's say EBITDA is 1 lakh. So the multiplier will be higher, correct? So it will become, let's say 70. So it becomes 70 lakhs. The valuation becomes 70 lakhs. So multiplier is something that is in context of this which you are multiplying. Here, since we are multiplying with dividend and earnings, so it means that what is in future that you expect that it is going to come. It is something very similar to PE ratio. Okay. But I'm just throwing some ideas. So this is what it is. Next, we have question number 9 also. Yes, the following information regarding the equity shares of M Limited is given below. Market price is given, dividend per share is given, and multiplier. According to Graham and Dodd approach, the dividend approach to dividend policy compute the EPS. Now, it is very simple. 58.33 is equal to 7. Dividend is 5 plus earnings we have to calculate for calculating the EPS. So I'm assuming E. So E, if we calculate here, it becomes 10. So the earnings per share is 10. Simple. Okay, Aisha? Yeah, I hope you would have more perspective to the multiplier now. Okay, Aisha? Yes. So this question is also done. Okay, students. Okay, let's come to next part, which is Lintner's model. So this is another theory now. Okay, so Lintner's model, what it is saying is D1 is equal to D0 plus EPS into target payout minus D0 into some kind of an adjustment factor. D1 is equal to dividend in year 1. D0 is equal to dividend in year 0. EPS is equal to earnings per share. AF is equal to adjustment factor. So students, now again, please don't ask me. It is very difficult on my part to explain this, but yes, I will try. So what Lintner's model is saying that they are helping us to calculate that what is your future dividend looking like, which is D1. So that is looking like whatever you pay now, in that you add whatever you are expecting to earn, which is this, multiplied by target payout ratio. Correct? So let's say target payout ratio, you are expecting that after 1 year, you will end up paying 80% of whatever you earn. And let's say you earn 100 and 80%. So you will end up paying 80 rupees. Correct? But you have already taken D0 here, right? So you will have to reduce minus D0. And ultimately, they are saying that this is not it. We will have to again multiply it with some kind of a adjustment factor. So let's see one question. We will be able to understand it better. Given the last year's dividend is 9.8, the speed of adjustment of 45%, the target payout ratio is 60%, and EPS for the current year is 20. Compute the current year's dividend using Lintner's model. D1 is equal to D0 EPS into target payout ratio minus D0 into adjustment factor. So D1 is 9.80, which is the dividend paid last, plus EPS is how much? EPS is 20. Target payout ratio is 60%, minus D0 is 9.80, which is already given, multiplied by 45%, which is the adjustment factor. So D1 is how much? 10.79. Okay, students. Then let's come to stock splits. Stock splits. So see, what is stock splits? Let's say there is a share which has a 500 rupees of face value. Right? In stock split, what I will do, I will split this stock into 5 more shares, 1, 2, 3, 4, 5, having 100 face value each. So I am splitting the fair value to 100. Any value. So overall value is not impacted, correct? Simple. Overall value is not impacted. So Darshan is saying that, no, Darshan, I would not say that these are practically irrelevant. I mean, they would have done some kind of research for both Graham and Dodd and Lintner's model to arrive at this kind of a conclusion. So we must respect that. And, you know, it might be used. I mean, I don't know where these are used, but I mean, let's respect the thoughts that are around them. Yeah. And maybe there would be some kind of a scientific, you know, evolution for determining this multiplier and adjustment factor. Okay. Yes. So stock split is clear. Okay. Then let's understand what is PE ratio. I think most of you would know this. Market price per share divided by earnings per share. Simple. And what is KE? KE is equal to EPS divided by MPS. So can I say that reverse of PE ratio is equal to KE? Yes, I can say that. Please focus, students. Please focus. These are some very important tips and tricks to, you know, handle your questions that are there. So P ratio is MPS divided by EPS, that we all know. What is KE? Cost of equity is earnings per share divided by MPS. which I can also say that reverse of P ratio, okay, which is 1 by P ratio. What is R? R is actually EPS divided by book value per share. That is called as R. Okay, students, let's come to question number 11 in this case. The following information pertains to Messrs. XY Limited, and it says earnings of the company is 5 lakhs. Dividend payout ratio is 60%. Number of shares outstanding is 1 lakh. Equity capitalization rate is 12% and rate of return on investment is 15%. Okay. This is R, this is KE. Number of shares outstanding is 1 lakh and dividend payout ratio is 60%. Calculate the market value per share as per Walter's model. So now we have arrived at Walter's model. Now these are some of the practice questions. Okay. As per Walter's model, price was dividend plus earnings minus dividend, R divided by KE, whole divided by KE. I hope this is understood. What is D here? 5 lakh is the earnings. Dividend payout ratio is 60% divided by 1 lakh shares, right? So 5 lakh into 60% divided by 1 lakh. This comes as 3 per share. How much is earnings? Earnings is 5 lakhs divided by 1 lakh. 5 per share. Essentially, this is 3 plus 15% divided by 12% multiplied by 5 minus 3 whole divided by 12%. 45.83 is the amount. The price will become 45.83 as per the Walter's model. Then second part of the question is asking optimum dividend payout ratio according to Walter's model and the market value of the company's share at that payout ratio. What is the optimum dividend payout ratio? So students, please note, KE is less than R. Optimum dividend payout ratio is 0. So we can write it, since R is greater than KE, it is better for the company to reinvest the entire amount and hence dividend payout should be 0. So P is equal to 0 plus 15% divided by 12%, 5 minus 0 whole divided by 12%, which is 52.08. So the price here becomes 52.08 at the optimum dividend payout ratio. I hope this is clear. Perfect. Thank you, Bhumika. Let's come to question number 12. Taking an example of three different forms, that is growth, normal, and declining, calculate the share price using Gordon's model. So this is very easy. There is no. So first of all, if we write what is the Gordon's model, P0 is equal to E1, 1 minus B, whole divided by KE minus BR. Simple. So you have everything, right? So you have E, you have B, you have even 1 minus B. They have given B and 1 minus B. And then KE is also there and R is also there. So everything is there and 3 times we have to put in the formula and calculate. So I'm skipping this question. Okay, students, please do try this in your respective homework. Okay, thank you, Darshan. Now let's come to the 13th question. Yes. The following information is given below in the case of Aditya Limited. Earnings per share is 60. Capitalization rate is 15%. R is 25. Dividend payout ratio is 30. Compute the share price as per the Walters model. So let's do this using Walters model. Price is equal to D plus E minus D R divided by KE whole divided by KE. 60 into 30% plus 60 minus 30% into 60, 25% divided by 15% whole divided by 15%. Hence the price becomes 586.67 per share. Simple. We have put down whatever is given in the question. That only we have put it down, right? Dividend payout ratio 30%, 60 is earnings per share. So that's all. Then the second part of the question. Yes, Manisha, you are right. Many formulas of these chapters are same as cost of capital. Yes. Then what would be the optimum dividend payout ratio as per the Gordon's model? Now, whether it is Gordon model or whether it is Walters model, both of them say the same thing, right? In terms of the optimum dividend payout ratio. What is it? It would be 0 because return is greater than KE. So this is 0. DP ratio would be 0. Okay. So question number 14. The dividend payout ratio of H Limited is 40%. If the company follows traditional approach to dividend policy with a multiplier of 9, compute the PE ratio. We know that PE ratio is equal to market price per share divided by earnings per share. That is P divided by E. Now using Graham and Dodd model, because they have given us a multiplier, correct? Multiplier we have used only in Graham and Dodd model. So we've written this formula. So P is unknown. This is what we know. Sorry, multiplier is actually how much? 9. Dividend we don't know. Earnings also we don't know. Divided by 3. But we know one thing. Dividend is equal to 40% of earnings. So D is equal to 0.40 of E. Correct? So if 9, D is equal to 0.40 E. So 0.40 E plus E divided by 3. So if we solve this, we come at P is equal to 6.6 E, and hence P divided by E is equal to 6.6. This is the PE ratio. This is PE ratio. Now, this is a very good question, students, because in this, we have to think and link whatever are the given supports in the question, the facts that are given, and hence we have to put it accordingly. Okay. So, students, I think till now we have covered good part of this chapter. We are at question number 14. So, we will wrap it here. We will conclude today's session here. Students, please note that your next session is on Sunday, which is day after tomorrow, the same time, 6 to 8:30. Okay. So we will cover the balance questions of dividend there. We will also try to revise the risk analysis and capital budgeting along with some good questions, along with some good 4 questions towards the end of this chapter. And I will take up some of the balance queries that are there. Okay. So thanks a lot, students. Till that time, please do revise well. Yeah, thank you. Technical team session.